I'm Curtis Chambers with the Chambers Financial Group. I'd like to share some thoughts on the market decline that occurred this week, the week of February 24th. The Dow slumped 12%. That's in the top 10 of all-time weekly declines. Now, we don't know the future, but as an English major, I recall what Shakespeare once said, "What's past is prologue." The idea is looking at the past may help us better understand the present and anticipate the future. The big news story this week was the coronavirus. I'm not an expert on epidemics, but I am a bit of an expert on market corrections. Having been a financial advisor for over 20 years, I've seen my share. My first observation is that the rapid market decline, like we saw last week, such declines are not abnormal. In fact, they're business as usual. There's an old saying, the market goes up like an escalator and down like an elevator. But I like to say, the market goes up like an escalator and down like an elevator with the cable broken. Market declines are often rapid, and this makes them disconcerting. Second, market declines are unexpected. A little over 2 weeks ago, if you think about it, the markets were at all-time highs, and everyone knew about the coronavirus. Suddenly, with no warning, there was widespread panic and a market stampede for the exits. Third, market declines are frequent. As you can see, since 1950, the S&P 500 has seen an average of nearly 3 separate 5% pullbacks each year. And fourth, the market has recovered quickly in the past from declines. Typically, it takes stocks an average of 121 days, or about 4 months, to recover from a correction. If the downturn becomes a bear market, which is when stocks fall 20% or more from a high, it takes an average of about 22 months, which is less than 2 years. So far, though, this is just correction territory. Now let me shift gears and talk about the wild card in all this, the coronavirus. I won't weigh in on what the future of this epidemic may mean for global health. Although again, I feel like an expert on colds and flus, only because I've got children in middle school. But it seems clear it is good news the coronavirus is being taken very seriously by global public health officials. So often we get the bad news, but not the good news. It seems to me the world is working hard to stem this epidemic. Remember the SARS epidemic in 2003? There was a concern that it would become a pandemic. And did you know the S&P did sharply decline initially, but went on to good returns for the year? The S&P also rose substantially during the Asian flu virus in 2006 and the swine flu in 2009 and 2010. Of course, the coronavirus may be different. I don't know. But there is such a thing as media-influenced public panics. The most famous media and public scare, in my mind, will always be Y2K. Back in 1999, if you remember, there was concern that computers were not able to register a 4-digit year, and all computers would crash when the year switched over to 2000, and the world would end. It didn't happen. Although the markets did crash a bit, the computers were fine. According to research by Ricker Sherman, writer for the New York Times, global contagions going back to the SARS virus in 2003 have seen a sharp slowdown in economic output like the one we're seeing now, lasting about a quarter, followed by a sharp recovery. Besides the coronavirus, how is the economic outlook as of late February 2020 overall? Well, the employment numbers are outstanding. Consumer confidence is high, and earnings have been surprisingly resilient, in spite of the fact that there have been several high-profile profit warnings from some major players due to the coronavirus. If it develops over the next couple months that the coronavirus is being contained, given the world effort underway, or just due to the end of flu season, the damage to the economy and consumer confidence would be limited, setting the stage for a potential second quarter rebound. If you've got concerns about the recent market declines, please call me or schedule an appointment at our Largo offices. We're not in it for the short run, not even for 1 week. We're in it for the long term.